A very good evening. Thank you for joining us here on Business at 9. I'm Nivedna Prabhu. Our top focus, Moody's Ratings, has affirmed India's long-term local and foreign currency issuer ratings and the local currency senior unsecured rating at Baa3 with a stable outlook on the back of robust economic growth and sound external position. In fact, the global rating agency also affirmed India's outer short-term local currency rating at P3. The rating affirmation and stable outlook reflect a view that India's prevailing credit strengths, including its large, fast-growing economy, sound external position, and stable domestic financing base for ongoing fiscal deficits will be sustained, is what it essentially said in a statement. All right, let's also put into perspective that India's industrial production remains steady at 4% in the month of August. In fact, mining leads to growth with 6% increase on a year-on-year basis, in contrast with the 7.2% that we saw in July. Now, manufacturing posted an uptick of 3.8% and infrastructure goods production rose 4.1% in the month gone by. But remember that in July, this figure was at 3.5%. Also decoding this, we have reactions from our experts. Let's hear what they have to say.
IIP, I think what we should look at is how the three major segments have performed, that is mining, manufacturing and electricity. So my sense is that there could have probably been a bit of a slowdown in manufacturing because when we are looking at things like electricity or even mining for that matter, we had seen a rebound taking place based on the core sector data which had come out some time back. So I think it's the manufacturing sector which has shown a kind of a slowdown, but still I think at overall, a number of 4% is very much within what our forecast was. We were looking at a number in the region of 4 to 4.5%. So I think 4% should be definitely comforting. But we should just remember that this particular number is for the month of August. So this is much before the GST reforms did kick in. So any impact of the reforms in terms of overall consumption, which feeds back into production, would be felt only after a month's time or so.
The core sector data had given a 15-month high number of around 6.5%. It's the manufacturing which is showing some downward pressure, which is why IIP is just stuck at close to 4% mark. The only one point to match is that where also I agree with sir, that on mining and even electricity, initially they were in the contraction zone, specifically mining in the contraction zone, because rains were front-loaded this year, and that's led to pressure on mining activity itself. But manufacturing is one area which may have come under some downward pressure starting 15th August, because the demand for products deferred at least from 15th August till 21st September before GST reform kicked in.
All right, let's move on from that and put into focus how the debt-ridden Vodafone Idea has filed a new petition on the Supreme Court. In fact, in its new petition, we have sought a waiver on the interest and penalty components of its outstanding AGR dues. Remember, the case has been deferred, but overall, given the significant legal development, Samir Dixit filed this report earlier today as to what that means. Let's listen.
The debt-ridden telecom company Vodafone Idea has filed a new petition in the Supreme Court, and its a new petition. Vodafone Idea has sought a waiver on the interest and the penalty components of its outstanding AGR dues. In the fresh petition, the Vodafone Idea has cited an old example or an old ruling of the Supreme Court where a 9-member bench heard a case, and this case was related to the Mineral Area Development Authority versus the Steel Authority of India. Now, this particular case, the 9-member bench has actually waived off the additional dues that was there. And citing the same example, Vodafone Idea in its fresh petition has said that the additional or the penalty that has been levied, it should be waived off. Vodafone Idea has also argued that the similar kind of principle should be applied in their telecom company's case as well. Now, the company has been arguing that waiving the interest and the penalty will help to get off the debt which is there on the telecom company, and this will help to improve its financial performance as well. Center has also appealed to the Supreme Court that they want to expedite the entire ruling or the case, and have sought October 6th as the date of the next hearing. Now, this is not the fresh petition, because earlier also we have seen that Vodafone Idea has filed a similar kind of petition in the Supreme Court, and they have argued that the penalty that has been imposed or the additional additional amount over and above the AGR dues, the entire calculation has not been done properly, and the entire calculation should be done once again. So based on this, there are two separate cases which are there in the Supreme Court, but a new petition that has been filed, and it has sought a complete waiver of the penalty and the additional interest of its outstanding AGR dues.
All right, from that, let's shift our focus to how, with medical inflation on the rise and no standardization in the hospital industry, insurers are now batting for a health regulator so that we adopt global practices in pricing and treatment protocols, which would also benefit consumers. Let me take that across to Anurag Shah, who has the details of the letter that was submitted by the industry to the DFS.
Tussle between insurers and hospitals going on. We have seen in last 2 months that Hospital Association is suspending cashless treatment for few insurance companies. On the other side, insurance companies are also not empaneling a few big hospitals. So in this issue now, insurance industry has submitted data to Finance Ministry, Department of Financial Services, pushing for health regulator in the country. So as per the data submitted by insurance industry, there is an urgent need of health regulator in the country. So data also says that medical inflation in the country is increasing double digit, and with this continuous increase, health insurance will be unviable for many policyholders going ahead. Other than that, the other point shared by the insurance industry in a data and a letter to DFS is that hospital charge different rates, creating unprecedented claim outgo, and health regulator can standardize the tariff. Insurers also flag the frequent disputes between tariff and deduction raised by hospitals, disrupting the cashless services. So we have seen in last 2 months only that hospitals are suspending the cashless treatment for various insurance companies. So that issue also been raised. Insurers believe that standard rules would cut disputes and litigation between hospitals, and customers will get the clarity, policyholders will get the clarity. And on the global practice front also, most of the countries, many nations have a health regulator on pricing and treatment protocols, but in India still it's awaiting only. So these are the main points and data shared by insurance industry to the government, to the Department of Financial Services. So in coming days, this data shared by insurance industry will be taken up with the health ministry also to have a talks with various stakeholders. One another important point mentioned by insurers is that in last few years we have seen that PE investor, the private equity investors, is pushing hospitals to chase for higher revenue and profits, and raising the healthcare cost, both insured and uninsured patients. So these are the main points shared by insurance industry to Government of India, Finance Ministry, to push their demand for health regulator in the country.
All right, let's move on to another exclusive. Sources tell ET now that Oil Ministry has sought cabinet nod for amendments to the PNGRB Act. My colleague Prakash Priyadarshi had filed this report earlier today as to what we're picking up. Let's take a look.
Well, in a move to carry out major reforms in the oil and gas sector, the Oil Ministry has sought cabinet nod for gas marketing and pipeline infrastructure reform. So very significant development coming in. In fact, the ministry has sought cabinet approval to amend PNGRB Act that will cover infrastructure and gas marketing reforms for all energy sources, which include green hydrogen, green ammonia, ethanol, compressed biogas, and so on. A very significant development coming in. The proposal on which the ministry has been working for quite some time has now been sent to the Indian cabinet for approval. We're given to understand that the PNGRB to be empowered to regulate gas pipeline infrastructure for all type of energy sources. Transport system operator, which is called TSO, will be formed to manage all common carrier pipelines in the country. TSO to be brought under PNGRB regulation. Sources are also indicating that the GAIL's pipeline infrastructure, along with other companies, to be included under a TSO framework. Government will retain majority stake in transport system operator, where PSUs such as ONGC, HPCL, GAIL, IOCL, EIL may hold equal minority stake in the company. The objective is to create a system where level playing field could be provided to the industry.
Time for a quick break. Stay with us. We're going to be right back with lots more on this. Welcome back. You're watching Business at 9. Now, let's tell you how the centre has issued operational guidelines for the rollout of nearly 72,300 public electric vehicle charging stations. This is across the country under the Prime Minister e-Drive scheme. Now, according to the Heavy Industries Ministry, the framework provides a tiered subsidy structure to accelerate the installation of charging infrastructure at government premises, highways, public transport hubs and commercial complexes. Sameer Dikshit filed a report on this earlier today. Let's take a look.
To make electric vehicle more popular and successful in the country, the government is focusing not just providing subsidy for the electric vehicle, but also for the supporting EV charging station, which is the required infrastructure. Recently, government has launched the PM e-Drive scheme with a total budgetary outlay of rupees 10,900 crore. And under the same scheme, the government is providing a subsidy of rupees 2,000 crore for building up the EV charging station, the required infrastructure. And for the same, now the government has released the operational guidelines for this entire EV charging station for the infrastructure. Now, this entire subsidy scheme is a layered or a tiered-based subsidy scheme where based on the level the subsidy will be provided. The first level or the level A is for the government premises being handled by the central or the state government, for example, the hospital or the educational institutions. For these sort of institutions which are being handled by the central and state government, 100% subsidy will be provided for setting up of EV charging station, for the uplinking infrastructure and also for the EVSE, which is the electric vehicle supply equipment. 100% subsidy will be provided. Conditionally, the charger it is available for free public use. Then comes this level 2 or the second level where the premises which are being handled by central and state government, for example, the railway stations, the oil or the petrol pump stations, even the airports, which are handled by the PSUs as well. So for this sort of setup, 80% of subsidy is provided for the uplinking infrastructure and 70% is provided for the EVSE, for the supply equipment. And then comes the level 3 where the EV charging station set up at the shopping center and other premises. 80% subsidy is provided for the uplinking infrastructure. Even for setting up of battery swapping stations and the battery charging stations at other premises or the other locations, 80% of uplinking infrastructure subsidy can be provided. Now, this entire purpose of this subsidy-based scheme is to promote and encourage the central and the state government and also the PSEs, the public sector enterprise, to come forward and set up more and more charging infrastructure. Initially, government is targeting those cities having a population size of more than 1 million.
All right, let's move on because it was a volatile day of trade on D Street as markets swings between gains and losses. Sensex Nifty 50 extended losses to the 7th consecutive session. The Nifty Bank, in fact, snapped its 3-session losing streak, while broader markets also ended their 5-session losing streak. Now, the Nifty PSU Bank was the top sectoral gainer, ending its 3-session losing streak as all constituents were in positive territory. But realty and energy stocks saw good gains today, while the metals also ended higher in trade. This was led by Hind Zinc and Hind Copper. Nifty Auto was the top sectoral loser, falling for the 4th consecutive session. Remember, while Nifty and, while IT and Pharma continued to their underperformance. All right, let's shift our focus to the big development, given the fact that SEBI has issued a final order against Man Industries India and promoters. In fact, the markets regulator finds that the management failed to consolidate its arm Merino shelters. Ankur Mishra, my colleague, joins in on the phone lines for more details. Ankur, very good evening and significant development. If you could put that into perspective as to a key takeaway that we know so far.
Yes, definitely. The order of SEBI has now been passed against Man Industries and voters, and the action has been taken because there was a complaint of fund diversion as well as misrepresentation of financials. And after that, SEBI came into action. The interim action was announced. And now SEBI has concluded that forensic audit has found non-consolidation consolidation of subsidiaries, that was MSCL, and they have hidden the losses actually. In fact, market regulator has also mentioned that there was a misutilization of funds, undisclosed related party transactions or RPT, and all these were found in the final order. And how it was done, the loans of over rupees 560 crore was routed to subsidiaries, and later on it was actually converted into loans. So all this misrepresentation of facts was done by the company as per the allegation which is there in the final order of SEBI, and company failed to disclose the pledging of subsidiary shares of credit facilities, and therefore the act of SEBI has been found in violation, which includes SEBI Act as well as PFUTP and LODR regulations. And therefore, now SEBI did issue earlier show cause notice and multiple hearings were held, and now SEBI has concluded that violations were established.
Right, Ankur. Thank you very much for joining us with those important details and more importantly, putting that into perspective for our viewers. But for the moment, we leave the conversation at that. From that significant development, let's move on to what really transpired after India won the Asia Cup, because there's plenty of drama that's unfolded after the final, of course, where India defeated Pakistan by 5 wickets yesterday. But remember, the Indian team refused to collect the winner's trophy or their individual medals at the presentation ceremony. This was because the Asian Cricket Council chief, Mohsin Naqvi, insisted that he would give away the trophy. The Indians refused to accept the trophy from him because ACC chief Naqvi is also the Pakistan Cricket Board chairman and the Interior Minister of Pakistan. Let's also tell you that the ceremony was delayed by over an hour before it wound up without a trophy presentation. Now, earlier in the game, Tilak Verma and Shivam Dube's crucial partnership brought India back and guided the men in blue to a 5-wicket win against Pakistan last evening, helping the team clinch their 9th Asia Cup. But also the man of the moment in terms of the captain of the team, and my colleague Times Network's Karishma had an exclusive conversation with Surya Kumar Yadav. Let's listen in to that excerpt.
I think, as you said, it was a bittersweet thing at the end of the tournament. This is the first time we've seen after winning a tournament that some team has not received a trophy going back home. But it's okay. As I said earlier yesterday in the press conference as well, all the trophies, the real trophies, are the people who are in the dressing room, the 14 players and the support staff. So all those, they have played a big role. So those are the real trophies which I have won during the course of the tournament and hopefully going forward in the near future as well. Even our honorable PM sir is also playing cricket on front foot. It's good to see, and if a strong leader like this is standing besides us, then we just have to go out, play our game with a cool mind and just be relaxed and happy. And at the same time, it came in my mind suddenly that this little bit every Indian can do to help our armed forces, victims of Pahalgam attack. So I just thought of it and did it by surprise.
All right, before we wrap up, let's tell you what Wall Street is looking like, because major US stock indices are mostly higher today after last week's losses, while the dollar and treasury yields slip on fears of a possible government shutdown. Now, the Nasdaq, in fact, leads with the 0.7% gain. The S&P 500 adds 0.4%, but the Dow lags down 0.1% after an early bounce, that is. Now, Friday's session had briefly, remember, broken that 3-day losing streak. That was thanks to the inflation report that came in line with expectations. But still, the major averages ended last week lower overall, because AI chip giant Nvidia is leading the rebound, climbing about 3% after last week's doubts over the AI trade. Other chip makers are also rallying. AMD is up 2% and Micron surges nearly 5%. But in corporate action, shares of Electronic Arts jumped 4% after the video game maker announced a $55 billion take-private deal, and deal-making overall is on a roll in US, and M&A has already crossed the $1 trillion mark this year, up 29% from last year. This is according to Goldman Sachs. All right, that's what Wall Street is looking like. But for the moment, that's all that I have for you in this edition of Business at 9. Thank you very much from my team and I for joining.